It's Monday, the 16th of January, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and we are officially back for the new year. This week, our morning podcasts are going to be a little bit shorter than normal, but still obviously full of the latest news. Then next week, our full range of podcasts will be back, the morning edition, the afternoon edition, a daily interview, and of course, the Fast Five episodes for those who want to hear the news in just 5 minutes every morning and afternoon. And of course, I'd like to welcome back to the regular show for the first time in 2023, Sean Aylmer. Good morning.
Good morning, Michael. Look, I loved the interviews over Christmas, but I've got to tell you, I'm a news hound. Yeah. So, end of the day, I love podcasts about news, and we'll be back. We've got so much going on already this year, and I'm looking forward to 2023. I mean, 2022 was a pretty crappy year, really, if you look at equity markets and sort of risky assets and things like that. Bit of a shocker. Can't be as bad this time round, surely, Michael.
You know what? I'm going to play that back to you at the end of 2023. And the quote is, 2022 was a pretty crappy year. Surely 2023 can't be as bad. And we will see. And we will see, Sean, how that actually goes. You mentioned the interviews that we've had over the last couple of weeks. There's been some really interesting things in those interviews. And it's actually worth, if you haven't heard them, just going back and having a listen, because in 5 minutes, you basically get a snapshot of what experts expect from this year, equities and US markets, Australian markets, obviously, but into crypto and property, basically everything. So there's some really good guests there. They're all in the Fear and Greed playlist, and it's definitely worth going back and having a look. If you had to pick a favorite, Sean, it's like picking a favorite child, could you do it?
It's just hard to beat Aussie equities.
Yeah.
You know, I mean, Matthew Kidman, some of the interviews with Matt were great. I mean, all the interviews were great, so I don't really want to single out any particular interviewee, but Aussie equities is kind of the bread and butter of Fear and Greed, so hard to beat them.
Yeah. I love the fact that you said I don't really want to pick out a favourite interviewee after you just done that. So.
Yeah, I know. I was retracing my steps, shall we say.
That's right. All right, look, I think we should jump into the show because we've got a fair bit to talk about today. Even though it is a slightly shorter program, we'll kick off the year, I think, by taking a bit of a look at the local share market because it has had a pretty good start to the year, up 3% last week.
Yes, that's right, Michael. Basically, there's a couple of bits of information helping all markets, including the local ASX. Number one, there are signs in the US that inflation is slowing, and that will eventually lead to a slowing in the pace of interest rate rises and ultimately an end to rate increases. Markets love that news. Number two, the easing of COVID restrictions in China, notwithstanding the severe and traumatic health impacts, has encouraged equity investors. The S&P ASX 200 closed at 7,328 points on Friday. That's only down about 5% from its peak of April last year. Much, much better than Wall Street, for example. And the view among traders is that it could keep running for a little while yet. So really, we're kicking off the year with good news, Michael, shall we say?
Yeah, and look, you've already kind of made your broad prediction for the year saying that 2023 won't be as bad as 2022. But do you have any kind of more insights as to what we can probably expect?
I think we should leave that one to the experts.
Very wise.
Diana Messina, I noticed over the weekend, Diana's from AMP, she reckons Australian shares are likely to outperform again. That's vis-a-vis Europe and the US. That's helped by stronger economic growth than other developed countries, and ultimately stronger growth in China because of that the easing of the COVID zero policy. Stronger growth in China helps commodity prices, which of course, when you're a country like Australia or Canada's another one, you benefit very directly from that. So Diana reckons that the ASX 200 will end 2023 at about 7,600 points. That's not a huge jump, but it would be a record.
That's I really like it when people will put a number on it. I like a definite kind of prediction. Gives us something to work towards.
Yeah, I agree. We like people putting numbers on things. I suppose what this is showing is that risk assets are back in favor, not totally, but somewhat. The great example of this is Bitcoin, the cryptocurrency. It jumped 11% over the weekend. It's trading around $21,000 a unit. Now, that is the ultimate risk asset, or cryptocurrencies are close to the ultimate risk assets. Bitcoin, the biggest of them, but that is back to 21,000. So obviously investors are interested in risk assets again.
Now, Sean, we enter 2023 with the housing market in pretty poor shape, with prices still falling and really little hope of a turnaround anytime soon. And much of that is, well, obviously because of rising interest rates.
Yes, this could be my exception to the comment earlier on. I'm not sure where house prices will end up by the end of this year. It would be great to say they'll be flat, but I think there's a little way to go first, and they'll have to turn around in the second half of the year. It's really showing in the data that's come out in the past few days. Home loan approvals are tumbling according to the Bureau of Statistics, but mortgage refinancing is soaring as people look for better deals. In fact, refinancing jumped more than 8% to nearly $20 billion late last year, and that was in the month of November. It's about 20% up on a year earlier. That, of course, is because people are noticing higher interest rates, thinking, I think I better refinance my mortgage. The home loan approvals figures released on Friday show 10 consecutive months of falls in home loans approved. 10 months. That's back to pre-pandemic levels. Pretty incredible. Now, remember, house prices have fallen by 8.6% from their peak nationally and are down 13% and 9% in Sydney and Melbourne, respectively. Those falls have really taken the sting out of the market. And given the Reserve Bank meets again in about 4 weeks' time, the first Tuesday of February, we didn't have a meeting this month, the first Tuesday of February, so Michael, that's probably 3 weeks away. We'll find out then a little more about what's going to happen to interest rates this year.
Now, Sean, I don't know whether we have many lobster farmers listening to Fear and Greed.
Oh, huge listenership among the lobster farmers.
We're big in the lobster farming community, but I've got some good news for them because a senior Chinese diplomat has visited a major Western Australian lobster exporter, which is a positive sign that Beijing is inching towards relaxing rules on $20 billion worth of Australian imports.
Yes, it's a good anecdote to a much bigger story. Now, just in case you haven't been following the news in the last couple of months, remember late last year, there was a high-level meeting between the foreign ministers of Australia and China. That was the first high-level meeting between the two countries in 3 years. Discussions have been continuing, hoping for a breakthrough on restrictions imposed on everything from beef and wheat to barley and wine, those sorts of things. Lobsters were also hit, though recent reports suggest there's been a surge in sales to Taiwan, as it turns out. Apparently from there, they're being smuggled into China. Anyway, the huge majority of Western Australian lobsters that left our shores used to go to China. Looks like that market might be reopening for lobster farmers. There's been a fair bit going on over the past fortnight or so. Last week, it was reported that China had lifted bans on reasonably priced coal, with the first batch expected late next month. Also on Friday, China raised its import quota on Australian wool for this year. And last week, it emerged that Australian and Chinese trade negotiators in Geneva had begun discussing the possibility of Australia dropping its WTO challenge to China's punitive tariffs on barley and wine. Certainly, both sides are giving a bit at this point, and that is good news for the Australian economy at least.
Yeah, there's plenty happening in that space. Now, Sean, we're not really an investment podcast, and we certainly suggest and encourage people to speak to a professional about making investment decisions. But here's an alternate investment option, something I've never considered before: service stations. The latest Ray White commercial figures on servos says that yields, what you can get back from investing in a servo, have jumped by nearly 30% over the past 12 months to close to 6%.
Who would have thought? Servos. And that, of course, 6%, much better than putting your money in a bank. It compares pretty well to most dividend yields on the stock market as well. Of course, it does come with more risk. Nearly $1 billion worth of servos changed hands last year. That's about 50% more than 2021. Now, the reason? Higher mortgage rates and lower valuations for service stations have provided enough incentive to put a rocket into the market. Servos are pretty popular with many investors. Mostly you buy the property and then you lease it out to a blue chip organisation like Coles Express or Woolworths, Caltex, 7-Eleven, someone like that. Also, they're often on highly visible and popular sites. So you're owning the property on these sites, which potentially you can redevelop in the future. The fly in the ointment, of course, or perhaps the oil in the petrol or some sort of metaphor like that, Michael.
No.
Air in the diesel? No?
No, okay.
Fly in the ointment.
Please,
yeah, keep going.
Please move on.
The challenge for these service station operators or the owners of the property is what happens when electric vehicles are adopted en masse. Hasn't happened so far. It obviously hasn't hurt service station property yields, but we all know EV charging stations don't tend to be in service stations. They tend to be in places like supermarket car parks and kind of around parking lots. So not quite sure how that one plays out, but it's just interesting. You can get 6% on investing in a service station at the moment.
Now, Sean, I had told myself to give it a little while before I start talking to you about diesel prices. Wasn't expecting to do it in our first regular show back for the year, but I'm going to mention one of the highlights for me of the last few weeks was getting diesel for $1.99.5.
I'm very pleased for you. We got a great email over the last couple of weeks. I think it was on Facebook, and it was just someone saying, hey, when can you bring back the regular shows? And the comment was something nice about you and something about my self-serving rants. And I'm just really pleased that so far this year you've had one self-serving rant. I've had none so far.
Well, tomorrow I'm going to share that full message that we received via Instagram. You can join us on Instagram. Yeah, Fear and Greed podcast. And it's actually it's a very, very nice message from a listener.
It is very nice.
I will share that tomorrow, but yeah, that you were spot on there. You do have self-serving rants. All right, finally, we can't start the new year, Sean, without a look at international markets. Chinese tech stocks are surging and Wall Street tech stocks are slumping. That kind of seems the gist of it, really, isn't it?
Yeah, that's pretty right. Let's start on Wall Street. It ended last year meekly, but it's had a pretty good first couple of weeks in 2023. According to Bloomberg, 5 of the really big companies, that's Apple, Amazon, Tesla, Microsoft, and Meta, are responsible for nearly half the S&P 500's losses over the past few months. Apple and Microsoft are the 2 largest companies, each worth around $2 trillion. That's about 11% of the index. They've gone backwards, so the index has pretty much followed. But there's a bunch of other companies outside those top 5 that have done really well. Boeing has done really well. United Airlines, Warner Brothers, Wynn Resorts, which is a casino group. They've all had a really good period. So the story on Wall Street broadly, and this has been exacerbated by the fact that recent CPI or inflation figures in the US have not been as high as forecast. So some of those more consumer-based organizations have done pretty well. In terms of China, tech stocks are definitely back in favor. Well, probably more accurately, Chinese tech stocks are back in favor with global investors. The end to COVID zero has triggered a 60% surge in the Hang Seng Tech Index, that's the Hong Kong index of tech stocks, since October. Now, it's still half its February 2021 peak, but still it's on a run. Of course, the big factor in China is what's happening with COVID. Yesterday, the World Health Organization urged China to share more detailed information on its coronavirus situation after Beijing reported there'd been almost 60,000 COVID-related deaths in the country since early last month. Quite incredible.
Yeah, certainly is. Look, there we go, Sean. I think we've pretty much kind of wrapped up everything that we need to for today. There is plenty happening. As I mentioned, we've got plenty of interviews there from the last couple of weeks. If you'd like to go back and have a listen to those 5-minute snapshots of everything that you might expect this year. Thank you very much, Sean.
Thank you, Michael.
It's Monday, the 16th of January, 2023. Make sure you're following the podcast. Join us online on LinkedIn, Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.